Between the market peak in January and the summer of July 2026, spot gold lost a staggering 20% of its total market value. Spot gold reached a record $5,600 an ounce in January, before sliding to $4,120 today. This steep drawdown leaves the asset's future path unclear, creating intense uncertainty for investors who bought the top. These price movements are occurring as global markets realign around shifting interest rate targets and historical trading friction. Navigating this environment requires understanding Wall Street's expectations, but those expert models are currently divided. Major banks and analysts have published forecasts for the end of 2026 and 2027 that are fundamentally at odds with one another. JP Morgan projects a climb towards $6,000 an ounce. Conversely, HSBC lowered their forecast to $4,560. Meanwhile, technical analysts warn a further downside, targeting a sharp drop toward $3,440. To evaluate these targets, we need to look past the price numbers and identify the specific macroeconomic triggers driving each model. Ultimately, the most relevant and actionable forecast for your portfolio depends entirely on which of these economic forces you choose to prioritize. The primary headwind for gold is the hawkish monetary policy of the U.S. Federal Reserve. Inflation remains a concern, which has forced the Fed to maintain elevated interest rates longer than markets had anticipated. These prolonged high rates lead to a stronger U.S. dollar, which exerts downward pressure on commodities like gold. For investors, this environment creates a dilemma centered on opportunity cost. This comparison shows the trade-off. Gold provides zero yield, meaning investors sacrifice the 4 to 5% returns currently available from cash and government bonds. This yield sacrifice is the central reason HSBC lowered their 2026 forecast to $4,560. While the Fed remains hawkish, the availability of high bond yields acts as a limit on gold's upward momentum. The opposing view focuses on the structural and geopolitical risks that could ultimately push gold prices significantly higher. Tensions in the Middle East, including military exchanges between the U.S. and Iran, remain a persistent driver of safe haven demand. These geopolitical flashpoints create a premium on the price, as institutions buy gold to protect against sudden instability. There is also the structural risk of rising U.S. sovereign debt and fiscal deficits, which may undermine the long-term stability of fiat currency. While retail investors have sold off ETFs, central bank gold buying remains a consistent factor, providing a base level of price support. JP Morgan and Goldman Sachs weight these structural threats more heavily than interest rates, leading to their targets of $4,900 to $6,000. From this perspective, gold functions as portfolio insurance against geopolitical events and debt-related shocks. Some technical traders ignore these long-term macroeconomic narratives entirely and choose to focus strictly on the immediate price action. This candlestick chart shows the 200-day exponential moving average, a critical indicator. In early June, gold broke below the $4,290 support level, crossing under the line. That breakdown triggers algorithmic selling, projecting a decline toward $3,440. The risk here is a weak U.S. labor report could force the Fed to cut rates, potentially causing an abrupt short squeeze. Technical models treat gold purely as a tactical vehicle, where immediate price momentum overrides macroeconomic hedging. Deciding which forecast to follow requires you to evaluate your own investment objectives. Consider if you fit the profile of a yield-seeking optimizer. This investor prioritizes guaranteed returns and liquidity, making them sensitive to the zero-yield nature of gold. Alternatively, you may be a long-term hedger. The hedger looks past short-term price drops, using gold to preserve wealth against inflation and systemic shocks. Finally, there is the technical momentum trader, who seeks to profit from chart volatility regardless of the underlying fundamentals. Identifying your profile is the first step in determining which banking model aligns with your strategy. This flowchart maps the goals. If you are a yield-seeking optimizer, your priorities align with the assumptions in the HSBC model. For this group, keeping capital in high-yield assets is the priority until the Federal Reserve moves toward rate cuts. If your goal is wealth preservation, your strategy aligns with the JP Morgan and Goldman Sachs models. A long-term hedger views the current drop to 4120 as an accumulation entry point for multi-year protection. A technical momentum trader maps most closely to the $3,440 bearish target. This strategy involves trading around the 4290 resistance line rather than holding for long-term targets. Each of these forecasts uses the same market data to solve a different problem. Your choice depends on whether you are optimizing for current yield, structural insurance, or short-term momentum.
Thanks for watching us. Please like, share, subscribe us.